Now, mutual funds. When we talk about mutual funds, again, it's like trading on a railroad track. We can only go one direction or the other. The mutual funds themselves are very limited as into what they can invest in. If it's a technology mutual fund, they can't go buy an energy stock. They can't go buy anything else other than what they are designed to do. So they can't change their load on the railroad truck. Can't go from cattle cars to hauling oil. Just can't do it. They can only move one direction or the other. They're long. They buy and they hold. They can't go short. They have to stay on the track. They can't just end the trip quickly and say, we're going to go to cash or we're just going to pull over for the night. As a matter of fact, if they see something coming up ahead, even way in the distance, there's something on the track, there's danger, they can't stop and avoid it. They may slow down a little bit, but they're just going to run right into it. Can't change the cargo easily. In addition to that, they don't have much choice. They've got to follow their own rules. It's called the prospectus. So the mutual fund, yep, you've got diversification, but you have all of those other things that come with it. And they make money, whether you make money or not. So you decide if mutual funds are for you, but as a cool trader, it's not for me. Exchange traded funds. Again, we talked about this in Stock Market 101. It's like a mutual fund, but we can trade it during the day. And yes, you can trade that with Cool Trade. We can trade the entire market as an ETF. The diamonds, the DIA, that's for the entire Dow. The spiders, the SPY, that's for the S&P. We can do silver, SLV. There are so many ETFs out there right now, and you can trade them through Cool Trade. It's a great way to go. It's a great way to trade, and there's less volatility involved too. So there's different ones, and there's ones that you might want to participate in, but ETFs are a great way to trade with Cool Trade in the market, and it gives you some diversification, not moving as quickly, and that's a good thing too. So now let's talk about the Cool Trade philosophy. You probably have heard this before, but I really just want to dig in a little bit on this to make sure that we understand what this is. Number one, with Cool Trade, we're dealing with stocks that we wouldn't mind owning for the long term. So we're not going to deal with penny stocks. We talked about that before. We're not going to deal with stocks that are kind of questionable or have low volume. These are typically big name companies that trade 1 million shares or more. So that 1 million shares or more are volume and trading over periods of time. We're typically not going to be trading stocks that are IPOs. We're going to wait till there's some history so we can see what it typically does in its cycles. In addition to that, we want high volume, which means 1 million shares or more. That provides liquidity. I can get in and out quickly. One of the problems with lower price stocks, penny stocks, is they may only trade 10,000 shares in a day. If you own 10,000 shares at a penny a share, I can't just sell it, can't just buy it, very low liquidity. In addition to that, one of the key points of the Cool Trade philosophy is to keep money on the sideline. Don't put all of your money into the trade at the very beginning. We want to have the ability to buy on dips. So as the stock drops 10%, we'll buy another lot, another 100 shares. If it drops another 10%, we'll buy another 100 shares. So again, part of the philosophy right from the beginning is to have money on the side to take advantage of those drops in the market. In addition to that, you need to have money management. So how do we do that? Well, with Cool Trade, instead of saying if it drops, stop loss, guarantee me a loss, what we say is we've got money on the sideline. We didn't buy it all at this price. When it drops, we're going to buy some more. And if it drops, we're going to buy some more. Having the money on the sideline allows us to buy on the way down, which is very foreign to what most people think in the market. They don't talk about adding to their losers. With Cool Trade, it's a part of what we do, having the money on the side, taking advantage of those drops. So in addition to that, we want to book profits consistently. So if the stock is trading at 10 and then 9 and then 8 and then 7, we bought stock all the way down as it's dropping. And now it's at 7 and it moves back up to 8. Well, it's time to harvest the crop because the $7 a share stock is now ripe. And I want you to think of crops for a moment. So that was the last stock we bought and it's the first stock we're going to sell. That's called LIFO, last in, first out. So it's at 7 and we're going to sell it at 8. We're going to book some profit. Then it goes from 8 to 9 and we're going to sell the stock that we bought at 8 on the way down and we're going to sell it and book profit. So last in, first out is called LIFO. That way of trading is a great way to go to lock in the profits consistently. And we always want to be in the game, buying and selling. This isn't where we're going to go to cash and just sit it out. No, we're always going to be in the game, and if it drops, we add to the position, and when it goes up, we take our profit. If we're always in the game and use this philosophy consistently, we're going to be able to make some money on a consistent basis. And by the way, that Cool Trade philosophy is built right into all of the formulas that are there for your the templates that you've got, so you can go through on the simulated trading. So don't think you need to know that all. Just use the simulated trading platforms that they've set up and see what it's doing. And all of those rules are kind of baked into the pie so you can see it clearly. So let's take a look at this. Do you remember when we talked about that buying the $6,000 worth of stock at the beginning, buy and hold, and then dollar cost averaging? Well, let's look at the difference between those two, buying it at the beginning and the dollar cost averaging, and Cool Trade and how we would do it there. Because if we bought it and held it, we didn't lose money, but we lost time and opportunity. Now, if we did the dollar cost averaging, that requires discipline. It requires me paying attention and putting the money in and making sure that I do it. Most people are not that disciplined to do it. But Cool Trade, if it's automated, what does that look like? When we lock in the profits, how does that look? Well, let's just take a look so we can see that clearly. With the dollar cost averaging, we went through that. We had the same $1,000 a month invested. If we sold it, we made $270 in profit. If we sold it at the end of those 6 months, how much did we have at risk? Well, eventually we had the full $6,000, $1,000 a month, $6,000 invested, that's $6,000 at risk. In addition to that, the average amount we had at risk, well, I started with $1,000, then I had $2,000, then $3,000. If we averaged it out, it's probably about $3,000 because $1,000, $2,000, $3,000, it would average out to the $3,000. So we have an average of $3,000 invested, and again, most people are not disciplined enough to follow through with that. Are they going to sell at the end of the 6 months and lock in that profit? Or are they going to hold on and roll it forward more than likely? So is there a better way? The answer is absolutely yes. Cool Trade is a better way. Because what's the purpose of trading anyway? It's to make money. So if we can book profits on a consistent basis and we can limit our risk and limit our exposure, we're kind of getting the best of all worlds, and that's exactly what Cool Trade does. So is there a better way? You bet there is, and the purpose is to make money. So how do we do this and put it all together? Same chart that I showed you before. $10 a share on the left, drops to 9, then 8, then 10, then 11, then 10. Let's just take a look at how Cool Trade would have handled this on a simple dollar up and dollar down. Again, on the first, we bought a 100-share lot at $10 a share. It drops. So if we're buying on a 10% dip, we're going to now buy another 100-share lot at $9 a share. It dropped again, 10% drop, buy another 100-share lot if we're just doing it at one lot at a time when it drops on that 10% move. And now on the fourth one, well, right here, we're going to sell because the stock moved up. So we're going to sell that stock that we bought at $8. We're going to sell it for the $9. And again, on the second one right here, we're going to sell the stock we bought at $9, sell it at $10. And then we're going to sell the next one here. The stock we bought at $10, we're going to sell it at $11. At this point, we're at all cash. And when it drops back down to $10, we enter the trade again. So when we add this all up, what does it look like? We booked $300 in profit. We actually have that much money in our account. In addition to that, the maximum we had invested at any one given time is $2,700. So we had $6,000 available, but $2,700 is the most we ever had invested. The average we had invested was about $1,300. So think about that. The average you had invested was $1,300, and over the course of time, you took out $300. So $300 on $1,300 is a very nice rate of return in 6 months. Now, if I say $300 on $6,000, okay, made 5%, that's okay, but in 6 months' time, again, I'm just giving you general numbers right here. I want you to get the concept. But if we've got just $1,000 currently invested, we've got $5,000 cash sitting on the sideline ready to buy on dips, ready to lock in the profit. So at this point, we got $6,300 in our account. $1,000 is invested, $5,300 in cash, and we're ready to buy. So that's really the difference between just buying and holding, dollar cost averaging, and doing it with Cool Trade, where we're locking in the profits and adding to our positions on 10% drops.